Hey everyone, and thanks for jumping back into the real estate verse. Today, we're going to talk about the ratio of new houses for sale over new houses sold in the United States. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the Into the Real Estate Telegram channel, which you can find a link to in the description below. Let's go ahead and jump in. So, we first should probably try to spend a little bit of time understanding exactly what this ratio is before just talking about what it means when it's going up and how it relates to the stock market in general. So, what we're going to do is we're first going to understand what it is, then we're going to overlay recessions, and then we're going to overlay the S&P 500. All right? So, if you think about this ratio in general, what would make it go up versus what would make it go down? If the denominator, or let's start with the numerator, if the numerator were to go up, meaning if the number of new houses for sale, if more inventory is coming on the market, if that were to go up quicker than, say, the number of houses sold, let's suppose that the number of houses sold stays the same. If the inventory for sale goes up, then you would expect the ratio to go up, right? If they go up by the same amount, then you would see no change. If the number of houses sold were to go up while the inventory stays the same, then this would actually go down because there's not a lot of inventory, the demand is going up. You would actually expect this to go down quite a bit. And then finally, if let's suppose the number of houses sold went down while the number of new houses for sale stayed constant, then this would also go up. So there's a number of ways that you could actually see this go up. But one of the more interesting things I think that's worthwhile to do is to look at what happens if we were to overlay recessions. Again, there has been a lot of talk about recessions. Again, we've already had 2 consecutive quarters of negative GDP. So from that academic argument, you could already argue that we're in one. From a different perspective, you could argue that we're not, especially because unemployment remains relatively low. If we overlay recessions, you can see, coincidentally, not always, but they tend to line up when this ratio spikes. Okay? When it spikes. Not all of them, but a decent number of these recessions line up to when this ratio of new houses for sale over new houses sold in the United States spikes. You can see it happen time and time again. Of course, over here in 2001, it did not. But I mean, you can have multiple reasons why you go into a recession, not necessarily that one that has to affect the housing market per se. But in general, when it does spike like this, we tend to see some type of a recession. What's interesting is so far, we're not seeing that, right? We're not seeing that so far. And you could argue that it's because, a recession is just not going to be declared, even though there's plenty of evidence to suggest we're in one. But again, if you were to take the counterpoint and play devil's advocate, again, you could always point to relatively low unemployment as the reason that you should not necessarily state immediately that we're in a recession. Again, if you overlay, say, unemployment rate with recessions, normally it's when the unemployment rate starts to go up that you get recessions, and we just simply have not seen that yet this business cycle. I mean, we have not seen the unemployment rate go up, which is why we're still not seeing, I think, a recession declared. If you go look at this chart, overlay it with recessions, to me, it seems like it's only a matter of time before this corresponds to a recession. Now, why is that important? Well, to some degree, I think it's important because we also know that risk assets tend to bottom during the recession, and we're not even in one technically yet based on that unemployment metric. If we were to overlay the S&P 500 on this chart, you can see that when this ratio is spiking, the stock market also tends to decline. So you can see it spiked over here in the late 60s and early 70s. We were in a stock market bear market. You can see this ratio spiked over here in 73 and 74. Again, a stock market bear market. Again, in the early 80s, same type of thing. To a lesser extent over here in the early 90s. And then, of course, we know what happened during the financial crisis. We had a fairly a fairly difficult bear market where we corrected more than 50% in the S&P 500, and at the same time the housing market came crashing down. And you can see that during that time this ratio went up a ton, and one of the main reasons for that is just the number of new houses for sale flooding the market. It was sort of like a race to sell your home. That was going up quickly, and so this ratio is spiking extremely quickly. And you can see over here, right? We're seeing that same thing play out once again, right? We're seeing it play out once again. But again, it does not yet correspond to a recession, though I suspect they will officially declare a recession in 2023, is my guess. I think they'll finally declare a recession at that point, and at some point in 2023, I'm guessing there's a decent chance, anyways, that the S&P 500 would actually bottom. If we go take a look at well, first of all, maybe we should take a moving average of this. So this is a 30 month SMA. Maybe we should go to a shorter time frame, like a 7-month SMA. You can see it's really starting to hit these levels that it hasn't hit very frequently, and every time it does something like this, for the most part, you do see it correspond to recessions. Now I want to go over to the monthly change and look at it like this. And what you'll notice is that the monthly change, it has not been this low since the early 1980s. Okay? So you're seeing it, you're seeing this change occur extremely quickly, and it hasn't really been this quick for the last 40 years. Okay? So that's how quick this ratio has changed in a relatively short period of time. We could look at it percentages if you prefer as well, but just the specific ratio is hitting levels that it really hasn't seen in quite a long period of time. The last thing that I really want to look at is to go back over to say this chart and compare, because I want to bring this back to crypto, because I do know a lot of people are in the crypto market. What's interesting is, Bitcoin in its entirety has only existed when the real estate market has been doing relatively well. Bitcoin was arguably born out of the financial crisis. And so we haven't really experienced a full-blown recession for Bitcoin at this time. There's a lot of indicators like new houses for sale over new houses sold. A lot of indicators suggest that we are quickly heading for a recession. The only time Bitcoin did have a recession was, or experienced one, was right over here in 2020, and you can see it was not a good response. We ended up going to new all-time highs, but arguably, again, the Fed printed our way out of it. So I sort of just wanted to make that quick point that Bitcoin has not yet experienced some of the financial conditions that we are finally experiencing today. But again, if you're more so interested in just the real estate side of things, I am starting to expand into that asset class. Again, I'm not an expert at it. I don't claim to be, but we're just going to try to look at the data and try to understand what it is telling us. So if you want to see more real estate content, make sure you subscribe, give the video a thumbs up. Also, let me know what you guys think about the real estate stuff in the comment section below. If you want to see more of it, less of it, just let me know. And thank you guys for tuning in. Make sure you subscribe. I'll see you next time. Bye.